The traditional bank is going to make us fill out an application for our loan. They're going to look at our debt to income ratio. They're going to tell us yes or no. They're going to tell us how much the interest rate is that we have to pay back. They're going to tell us how much we have to pay every single month. If we don't make the payment, they're going to come get our thing because whatever we got a loan for, something is collateral for that loan. And so if we don't make the payment, our thing that we use as collateral goes away. That being a house, a car, kids, whatever. The one thing, interestingly enough, to think about is the bank never wants your 401k or IRA as collateral. Should probably question why that is, because we don't know what it's going to be. It's unstable collateral. Hello and welcome to the podcast. Thank you very much for being here. All right, if you guys like this, please rate it and share it. That is helpful. So today I want to talk about the difference between IBC and traditional banking. Somebody asked me this on Facebook and they said, I have a rudimentary understanding of the infinite banking concept. And so why is it different to borrow from your whole life insurance policy versus the traditional bank? What is the difference? And let's first just address the rudimentary understanding of the infinite banking concept. If we are thinking infinite banking equals whole life insurance, we have a disconnect. We are not actually understanding the infinite banking concept. And I get those questions and I get those kind of comments a lot where, oh, I understand infinite banking. I just don't understand life insurance. Infinite banking is not life insurance. And so if we don't understand the thought process behind why we're using the policy and if we don't understand infinite banking, we don't understand the problem, which means we don't know what the solution is. Infinite banking is really just teaching us the problem. And the problem is how we think. The problem is all the noise. The problem is we don't understand the banking system and we don't understand the Federal Reserve. And there's a lot of stuff that's the problem. And then the solution happens to be the whole life insurance tool that allows us to accomplish and get what we want on the other side of that. And so when this particular individual said, what is the difference? I thought, well, that's a good topic, right? Because if he's got that question, then other people probably have that question as well. This may not be a long podcast because it's a pretty simple answer. But if we go to the traditional bank is going to make us fill out an application for our loan. They're going to look at our debt to income ratio. They're going to tell us yes or no. They're going to tell us how much the interest rate is that we have to pay back. They're going to tell us how much we have to pay every single month. If we don't make the payment, they're going to come get our thing because whatever we got a loan for, something is collateral for that loan. And so if we don't make the payment, our thing that we use as collateral goes away. That being a house, a car, kids, whatever, right? The one thing, interestingly enough, to think about is the bank never wants your 401k or IRA as collateral. Should probably question why that is, because we don't know what it's going to be, right? It's unstable collateral. All right. So when we look at the infinite banking concept, why is that better? So obviously, we're comparing a bank, using the bank to the life insurance policy at this point. So when we borrow against our life insurance policy, the difference is we control the loan. So we can pay it back whenever we want. Nobody is telling us when to do that. We can somewhat control the interest rate. The insurance company sets a rate and we have to pay at least that much, but we can pay more. We can't pay less, but we can pay more than that, right? If we miss a payment, our thing is not collateral to that loan. Nobody is coming to get anything. Nobody is reporting our credit score to somebody to ruin our credit. If we cannot pay for that thing that month, then if we die, it comes off of our death benefit. We don't lose our car. We don't lose our boat. We don't lose our camper. We don't lose our house. Whatever it is that you used that money for. When you needed that money, nobody asked what you were using it for. You didn't have to fill out some application. They didn't look at your debt to income ratio. You went online, you filled out a form, they ACH the money to your account. No questions asked. Not even when are you going to pay it back. It's 100% your responsibility to do that. Here's the bigger piece. If you borrow against your policy, your money never actually left the account. Your money stayed in there earning uninterrupted compound interest. So your money continued to earn interest even while you used somebody else's money. That does not happen when you take a bank loan, right? If you're going to take a loan from the bank, you're below zero. You don't have any money earning anything unless you said, I'm going to put my money in a CD and then I'm going to go to the bank to borrow their money. Then your money is earning something in a CD while you use the bank's money. What is the difference in that scenario, Mary Jo? Well, the difference is when the bank makes a profit, the shareholders of the bank get the profit. In the life insurance policy, the difference is you get the profit because you are a shareholder in the company, because ideally you have a policy with a mutual company. All of this stuff is in becoming your own banker. And Nelson said we should be using dividend paying whole life. Why dividend paying whole life? Because we get the dividend. So all these little nuances about infinite banking is all part of the concept. So we understand what those differences are. Instead of just comparing product, we're taking all the problems and we're looking at how banks work and we're applying that to ourselves. The other difference is if we put our money into a life insurance policy, we still have liquidity, we still have control, we still have the guaranteed uninterrupted compound interest, and we have the death benefit. So if we're going to go to the bank and get money, we don't have the death benefit, right? We've neglected the whole infinite banking piece. We're not doing infinite banking because we're just going to always do what we've done. So now we maybe have some term insurance that stays level. It runs out at some point in your lifetime where you're going to have to rebuy unless you are one of the unfortunate people that die before that term is up. That's 2% of people. And so you really there are so many pieces of this to say, oh, this is how it is and this is why it's so simple. I may as well just go to the bank. Or why don't I just use my savings account? Because again, if we use our savings account, we interrupt the growth of that. If we have a 401k or an IRA, we interrupt the growth every single time we take money out or the market crashes. So we want to make sure that we're looking at the whole picture. Liquidity is extremely important. If we go to the bank, we don't just automatically get a loan. And, obviously you guys know I work with farmers. And so when farmers think that it's hard for them to get a loan and it's easy for everyone else, it's not easy for everyone else. The people that have the best luck getting loans are W-2 employees because they have a guaranteed income coming in. They can look at their debt to income ratio, super easy peasy. If you are a business owner, which is most of the people listening to this, or you want to be a business owner, they have to look at all kinds of stuff. They want bank statements. They want all kinds of stuff. It is not any easier for a business owner to get a loan than it is for a farmer. Because guess what? Farmers are business owners. And so you don't have to do any of that once you want a loan from a life insurance policy. Like I said earlier, you literally go online, you fill out this online form, you submit it to the company, they ACH the money to your account. 3 to 5 days, you have access to your money, depending on if your bank holds it or what's going on with your bank. That liquidity is key. Do we want to start a business? What are we using the money for? Is it a home remodel? The bank might say, you know what? I'm not doing home remodels right now. With the economy the way it is, we are not doing loans for home remodels. Are we building a shop? They might say, nope, we don't want you building a shop. Are we starting a business? Nope, we don't think that's a good business idea. And so they're not giving you what you want to be able to go do what you want to do. If that money is in the policy, there is no question. It is liquid. You have access to it. You can do what you want. There are no controls over that. When I started my business, I took my money, paid my premium, borrowed against it, immediately started my business. I was super thankful that I did not have to go to the SBA for money because I would have had to make a payment. And in the life insurance industry, it takes you 3 months plus to get paid from a policy. And so you have this massive lag in income coming in, and they would have already wanted their payment in month 1, as if a new business owner makes money in month 1. None of them that I know. And so we want to make sure that we've got liquidity. We want to make sure that we have control. I want to make sure that I have uninterrupted compound interest, that I have some dividends, that I don't have any risk associated with it. I want to make sure that it's a mutual company, so I'm getting those dividends. And I don't want the bank owner to be getting those dividends because I don't own part of that bank. If I owned part of the bank, then bring on the dividends, but I don't. And so we want to make sure that we are hitting all of those key points that Nelson was talking about in becoming your own banker. So if you are somebody that is listening and saying, oh yeah, I get this concept because I actually listened to your podcast, or I listened to somebody else's podcast, or I was on some YouTube channel. No, you don't actually get the concept until you read Nelson's book or you read my book. And I don't want you just reading my book. I want you reading Nelson's book and my book, or just Nelson's book. I don't care. He has everything covered in his book. I didn't rewrite, but I wrote something easier to understand that gives you a good introduction to go to Nelson's book, Becoming Your Own Banker. So once we understand all the problems, then we can understand the solution is life insurance, and we know why that solution is being provided to us. So there you have it, folks. Let me know if you have more questions, comments, concerns. MaryJo@withoutthebank.com. If you have not gotten the book yet, go to withoutthebank.com, grab the book, and then schedule your appointment. I just got off the phone with a young guy that he can't move forward now. He went through the whole process and new job, we're moving, we're selling a house, and that's all good. It's all good. He'll be back when he's ready. I am not high pressure sales is the moral of that story. Okay, guys, let me know if you need me. Otherwise, you have a fantastic rest of your day.